Okay, good morning, everybody. 11 o'clock, so we'll get going. There's very little news to talk about this week, and we're running holiday season, but we are going to be talking to Matt Cable, who's the manager of Rights and Issues Trust. So, as I say, there's very little going on. There's just sort of interim reports and things. I did put out Finsbury Growth and Income because of what's happened this morning. It's a decent size, £1.5 billion. It's trading on quite a big discount. And you can see that discount's been steadily widening. That's a 5-year chart. And it doesn't seem to be sort of steady. The trend seems to be downward still. It yields 2.3, which, as I've said many times, I think is a bit too low for an income fund. But nevertheless, that it is going to be an income fund, and it's all about growing the dividend from here. So this is how it stacks up against the UK equity income sector. So discount-wise, towards the bottom of that peer group, but not excessive. And what's the reason for that? We'll come to. Dividend yield is by far the lowest. There was Troy was the other one that was sort of down there, but that merged with the Global Equity Income Fund, STS. Charges wise, reasonable, but market cap, it is the second biggest one in the sector, and I think that's why it's important to have a look at it. And returns wise, pretty dreadful, bottom really, unless you go to 10 years when it's suddenly second. And that reflects a big drop off in its performance over the last 5 years. And that's reflected in both the NAV and the share price. So you can see there. Now, the reason we're talking about it today is because it is the big holder of Hargreaves Lansdown. And this morning, the bid for that company has been recommended at £11.40. If you're a Hargreaves Lansdown customer, which many of you might be, I don't think you'll see an awful lot of change to start off with. It's been bought by private equity owners, but I think they'll just try and run it as is, and they may try and grow it. They may buy other things, as one of the things that private equity often does. And they may look for ways of improving the service and selling you more things. So it's another way of improving the profitability of it. Anyway, so £11.40, the board said yes, we will be happy to do that deal. It's a big chunk of Finsbury Growth and Income's portfolio, but there isn't much of an uplift that's going to apply to the NAV now because it was already valued at £11.32 on the end of June 2024. They also announced results this morning, and it's debatable how that would have gone down the market without the bid. I think it wouldn't have been taken very well, to be honest. And that's a pattern that we need to worry about a bit. So this is supposed to be a growth stock. Client flow inflows are still happening, but they have slowed down. And the underlying profitability may have been up slightly, but earnings were down, earnings per share down. So I can easily imagine that share price would have come off were it not for the bid. Now, this is a bit fuzzy, and I apologise for that. But what I've pulled here out, this is from the interim report. This is the Finsbury Growth and Income portfolio, just showing you the difference between September and the end of March. What I've tried to put here in the column, they more or less match up, is what the share price of returns have been since the 31st of March, so up until last night's close. And there have been some fairly big moves. This is the top 10 investments. Obviously, a very concentrated portfolio. It's one of the things that Nick Train does. Hargreaves was number 11 on that list at the end of March, and there's only propelled to the top 10 recently because of the bid speculation. So it's up 46% since the end of March there. But there's been some other things going against it, which we talk about in a second. So Finsbury Growth and Income's performance, which I've shown you was at the bottom end of the table, is way more than being caught out by Burberry, which is one of the things that happened most recently and attracts all the headlines. So just looking, I mean, I know there have been purchases and sales with the portfolio since, so this is slightly misleading, but had the portfolio not changed since the 31st of March, you can see that Burberry wasn't even the worst thing to hit the fund. Sage took more money off than that. Diageo is also a fairly big hit too, and so is Fever-Tree. And the worrying thing to me, and this is again the pattern of the way that Nick translates, he's trying for quality things, he doesn't mind paying up for them, which is why the yield is low. But these things, even after the falls, are still quite expensive. And to me, that's a worry. There are things that have offset that. So Unilever's done all right, and obviously the Hargreaves bid. But again, so you can see the Hargreaves bid that isn't the biggest positive thing either. So these Burberry and Hargreaves are attached to all the headlines, but actually it's Sage and Unilever that have had more of an impact. So stepping back a bit, the peak of the share price of Finsbury Income was in September 2019. And we're still about 12% off that, despite the fact the market's rallied a bit since then. They've been buying stock back, and they've been accelerating the process of doing that. So since the end of September 2019, when the share price started to crack, they bought back £227 million worth. But more than half of that has been bought back in the last 6 months. So the fund is really shrinking quite rapidly now. 10-year numbers are still okay. And it'd be nice to think that it will go back to where it was and be the best performing fund again. I think that's dubious. I don't think the market is likely to favour that in the short term. But it is worth, if you are interested in looking at it, given that it's on a wider discount than normal now, and you're wondering whether it might turn around, go back and watch the interview that we did with Nick on the 28th of June 2024. Okay, so that's enough from me.